Happy to be with all of you once again. We are here to share the financials that was approved by the audit committee and the board yesterday, and which we have published yesterday on the stock exchanges and today in the newspapers. And wanted to share some of the highlights, and then maybe once we finish that, we will want to take your questions and address all the questions that you asked to the best of our ability, and whatever we can't directly answer, we'll separately reply to you after the call ends, or maybe on a mail or something like that, or on a direct call. Maybe to begin with, at the end of the year, we were in about 20 states. We had a overall loan book of about 2,056 crores. During the fourth quarter, we had a total increase in customer base. The new customers who came in was about 39,529, which meant that during the entire year, we had a total number of 145,000 customers who came in afresh. Taking us to the total retail customer base, live customer base to about 516,000. During the year, maybe just to mention, during the quarter, we had a total disbursement of about 368 crores, and for the year, about 1,147 crores. Start the financial performance, which we have uploaded sometime back onto the website. During the current quarter, we have done a total disbursement of about 368 crores versus about 332 crores that we did in the immediately preceding year, and 290 crores that we did in the same quarter last year. So versus the last year, there is an increase of about 27%, and versus the current year, there is an increase of about 10 to 12%. That led to us taking our AUM, including the direct assignment AUM, to about 2,056 crores versus about 2,011 crores that we had in the immediately preceding quarter. And it was about 2,071 crores in the same quarter last year. March ending, we were at about 2,071 crores. The income out of this in the current quarter, what we have generated is about 108 crores, which is higher than the immediately preceding quarter when it was 93 crores. And in the same quarter last year, it was slightly higher at about 109.6 crores. So compared to the same quarter last year, there's a 2% drop. On the finance expenses, we have been very lucky. A lot is basis the credibility that the group has with lenders and anyone and everybody with whom we and the group are working with. Muthoot Professional Group has a lot of credibility. Basis which, in spite of this being a reasonably bad year, we were able to maintain the interest rates. We have been able to actually bring down the cost. The same quarter last year, the cost was at about 42 crores. This time it is at about 34 crores. In the same immediately preceding quarter, it was at about 36.3 crores. So the drop is on account of both reduction in the utilization of fund and also because of the reduction in the interest rate. Both being there, let us say it's about 75-25 ratio kind of thing. Therefore, the net interest income was at about 73.7 crores versus about 56.7 crores in the immediately preceding quarter and 67.7 crores in the same quarter last year. Operating expenses in the current quarter, in the immediately preceding quarter, and in the same quarter last year was broadly the same at about 42.3 crores in the current quarter, 43.3 crores in the immediately preceding quarter, and 44.3 crores in the same quarter last year. It is on the loan loss provision where we have taken a major hit. Maybe when I go into this particular slide in detail in the next sheet, that time I will elaborate on that. We have taken a total provision and write-off about 236 crores, leading to a profit or loss before tax of about 205 crores and a loss after tax of about 154 crores. On a full year basis, we had a total disbursement of about 1147 crores, leading to a book of 2,056 crores. The full year income was at about 398 crores versus 505 crores for the last financial year. The interest cost is lower by about 37 crores in versus the immediately preceding quarter. 37 crores compared. Sorry. Versus the interest cost versus the last year was down by about 37 crores, 25 crores because of reduction in the utilization and 12 crores because of the reduction in interest rates. And operating expenses was broadly the same was in the last year and this year at 153.7 crores last year and 152.7 crores in the current financial year. Its loan loss provision, which was at about 95 crores last year, and this year it's about 324 crores for the full year, which led to an overall loss of about 229 crores and a loss after tax of about 172 crores. It is here that I would want to elaborate on the loss figure and permit me to take some more time. If we were looking at a normal accounting, we were looking at a normal year where there were none of the two RBI circulars that I would now be talking after this, then we would have possibly in the fourth quarter versus 108 crores reported an income of about 16.5 crores or 117 crores. And we would have had a loan loss provision, overall provision plus other hits all put together of about 22 crores. And we would have possibly reported a bottom line positive of 13.5 crores after tax. That would have been the scenario, and the two circulars that I'm now going to talk about was not there. So on a full year basis, we would have possibly reported a loss of about 4.6 crores. That would have been the normal business. The provisioning that we are talking about is basis the ECL provision that we follow, and we have been consistently following, and something which we have been doing basis the trend over the last several years. We have taken the trend from 2014 onwards to determine what is the ECL provisioning. Now the two circulars which I would now talk about is one is the PCA circular. Now based on the figures that I told you just now, with a bottom line of about 13.5 crores for the quarter and a negative bottom line of 4.6 crores for the quarter, the GNPA was at the current year end at about 18.7%, down from 20.5% in the immediately preceding quarter, but higher from the 11.7% that it was in the same quarter last year. So versus after making the provisioning, the NNPA came to about 9.9%. And because it was 9.9%, to ensure that we don't come within the PCA categorization, it meant that collections had to be there. Provisioning has to be there to ensure that we don't come in the PCA categorization. I also wanted to mention that on a regular basis, capital adequacy was at about 27.7 crores. Capital adequacy ratio was about 27.7 crores. Now, to get out of the PCA on a normal basis, we had to make an additional provision of about 81.3 crores. We have made a provision of about 81.3 crores, taking the current quarter's profit to a negative from about 30 of about a negative of about 63 crores, and the profit after tax or loss after tax of about 47 crores. On a full year basis, the figure became negative of 87.6 crores before tax and 65.6 crores after tax. At this stage also, the intention was to come below 6%. Your NNPA had to come below 6%. The NNPA was at about 5.8%. The capital adequacy was at about 26.8%. Then there was this other circular of the 12th of November, whereby RBI had said that any account which goes to 90 plus has to come back to zero for it to be called a standard asset. So last quarter we had very clearly mentioned that, and including that we had reported a gross NPA of 27.7%. But basis the stand that we took and whatever is permitted in the India, there was no additional provisioning required because everybody, all other companies have done the same. The provisioning was basis the bucket in which they actually fell, because while they were in S3, as far as reporting, to treat them if they are treated as NPA concerned, strictly speaking, they were in S1 or S2. So provisioning of S1 and S2 is what applied. Subsequently RBI came with a relaxation saying that they would want that they give time up to 30th of September for companies to implement it. Effectively, implementation meant that the companies were given sufficient time to go to the market and get the customers to make the payment and do everything else that needed to be done to ensure that you implement it. We decided there are different stands taken by other NBFCs. We thought it was prudent to upfront recognize it as an NPA and then correct it over the next couple of quarters, next 2-3 quarters, and therefore bring it down that way. And that is the reason we took an additional hit of about 141.5 crores. Additional hit would mean that the provisioning would be higher. But then, because you already made some provision on these accounts, basis the lower bucket, that would get netted off. So the total hit of about 141.5 crores was taken, which was including a hit of income reversal of 8.7 crores. Based on that, we reported a figure of 204 crores negative for the quarter and 229 crores negative for the year, and 153.5 crores negative after tax for the quarter and 171.8 after tax for the full year. This is the entire provisioning that we have now done. The capital adequacy was at about 19.8%, and GNPA, while it was GNPA was 25.9% because we took this additional 148 crores as NPA. The NNPA then has now come down after the provisioning to 5.7%. I will pause over here for a minute, and I would maybe want to ask Madhu for his opening comments before we take questions from him.
Good noon to all of you. Thank you, Vinod, for your initial presentation. I think I'll give a brief perspective on how the two-wheeler market has behaved last year. What are the expectations in the ensuing year, and briefly, and then probably after that we'll open up for Q&A, because it would make sense in picking up the questions and giving more in-depth insight. Last year, after the second wave, we have witnessed two-wheeler industry actually bouncing back, and till September, October, and that's the festive season, we saw sales touching about 15 lakhs per month. Subsequently, we saw that around Q4, the industry has stabilized to 12 lakh unit sales per month, and Q4 sales, if I look at wholesale numbers, was about 34 to 35 lakh unit. Still the work from home and a lot of schools, colleges are yet to open, so that impact was seen during the Q4. Retail registrations had been stabilizing around 12 lakhs, and in Q4 retail registration was about 32 lakhs. As we go forward, we expect the sentiment to improve, in the ensuing months, especially from the fact that, and I had been giving this in my earlier commentaries as well, schools, colleges need to open, and which has happened across the country. and work from home facilities being withdrawn in a lot of organizations. So these are the initial sparks which is now seen in the industry. It is now slightly moving on the northern side. We also see there are challenges related to geopolitical crisis in terms of inflation, and everyone of us read every day in the newspaper. But that I believe is a temporary issue, because there is a impending demand of last 2 years, which customers, consumers have kind of kept on hold. They would have repaired their vehicles and used it again and again because the usage would have been less. We believe that with opening up of the market, I think as we go forward, numbers should look better as far as industry sales is concerned. I have always maintained that India is the largest two-wheeler market, and also it's a primary mode of transport for common men. We believe that this is the low. I mean, last year was the lowest, where the overall sales was about 145 lakh unit, and India has about 100 two-wheelers of every 1,000 people, which is very low compared to even developing nations. So we believe that this has to go double, given the bottlenecks in terms of commutation that is in our country. From MCSL perspective, our overall disbursement was about 309 crores for Q4, which is about 39,000 units. We had been benchmarking ourselves for the year 2020. I think this was the first step of crossing 300 crore, which we had been for the last almost 3 quarters. We've been doing more than 300 crore disbursement. And also I mentioned that with the opening up of the market, we have been able to reactivate a lot of business touch points, a lot of dealers, and of course our own in-house MFL branch network that would actually help this year. For the year, two-wheeler disbursement was 1,080 crore, which is about 1.42 lakh unit, which comes to about 1.18% market share of the retail registration for the country, retail registration of two-wheelers in the country, which is about improvement of close to 0.35% from last year. So we are seeing that the numbers are bouncing back positively. It is about this year when things open up and the sales start picking up from, let's say, 35 lakh and it crosses 45 lakhs, I think things should look much better. From collection perspective, we have seen collection picking up across all buckets. If I were to tell about generally X bucket collection for two-wheeler industry, it is about 93%. We were around 97% of the thing, and collection efficiencies were also above 100%, which is a very welcome sign. And when we look at our March soft bucket collections, we were 90 plus. So these are positive signs for us as far as bouncing back is concerned. It is a one-time hit that Vinod mentioned that we had to take, and being conservative and being an organization which has believed in being upfront, we have done that. But if you look at the trajectory that last 3 quarters that we have shown, we have been kind of improving quarter on quarter. I think we'll open it up for Q&A. We can get into more insights as the participants want. So over to you, Vidhi. We can open up. Vinod, if you are okay, if there's nothing more to add, then we can open up.
No, I think we will address the queries and write out first, and then subsequently anybody who has any other queries, additional queries, they are free to call us up separately.
Sure. Please go ahead, Vidhi. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Vinay Jadvani, an individual investor. Please go ahead.
Yeah, hello.
Yeah, hello, Vinay. Good afternoon.
Yeah, good afternoon. Actually, I'm highly disappointed with the results. Since other companies have also struggling, but our performance are really bad, I think. And from 2017, a company opted not to pay dividend so that it can retain it for future growth. That also didn't work well. So in between, others were also paying dividend and still are better placed. So by when could we see real turnaround and back to create a kind of a performance, and how much conviction you are having on the turnaround? Since I'm listening to the con call from last 1 year, I'm feeling little bit of hope, but still the performance is not materializing. So how? And second question is, how much could be recovered from the amount which has been written off in this quarter? These are the main points.
Vinay, thanks for your call. Honestly speaking, we are equally disappointed. And obviously, when we put it up to you, and it is your company, because you are the shareholders, we are not. So obviously, we feel far more disappointed to even present these numbers to you. Having said that, let me try and put it into 2-3 perspectives. First and foremost, the major hit on us came after the second wave, where the NPA shot up and then NPAs continue to shoot up for the next 3 to 6 months. Between the last quarter and the current quarter, the NPA, the GNPA had come down. GNPA had come down. In fact, we reported a negative of 15 crores at the bottom in the first quarter, about 8 crores or 7 crores in the second quarter, and then we showed a positive of 4 crores in the third quarter. Fourth quarter, on a normal business basis, we would have reported a 13 crore positive, and on an overall basis, we would have reported a negative of 4 or 5 crores. So that would not have possibly disappointed you or for us for that matter, because we said the way we look at it is we are improving on a quarter-on-quarter basis. But then obviously the speed is not good to satisfy you or us, and we are definitely not satisfied with it. But then there were these 2 circulars which we had to adhere to. We last quarter after the results also, in fact, we have been following up. We have been working with our team very closely over the last several months, saying that even before the PCA norm actually kicked in, saying that this number NPAs have to go down, and then while December was a month when the NPAs did go down a little bit, January again, and January was also good enough. February was a bad month, and because of this topsy-turvy kind of ride, the GNP at the end of the year remained at about 18.7%, and because this is the normal ECL, because ECL considers a longer term, and when they consider a longer term, the provisioning is basis that longer term, and therefore whatever provisioning is needed as per ECL, we were doing, plus some bit of management overlay also we were providing even till the last quarter. Because and the team was always confident that we will bring down the NPA to the threshold demanded by RBI, but they were not able to do that in spite of their best efforts. And when that happened, at the end of it, like I pointed out in the presentation, that we had to actually charge off 81 crores purely on account of just getting out of PCA. On the second part, this is the 12th November circular. RBI had given time, but then the company management felt that no, it is appropriate that we don't take the benefit of the relaxation given, and we actually make provision for it. Tell the regulators and everybody saying that no, in spite of the provisioning being there, and we adhering to the threshold of 6%, which the regulator has demanded. Even on the capital adequacy, we are pretty comfortable at close to 20%. And then work on the next couple of quarters to recover the amounts, especially the ones which is about 148 crores, which have gone beyond 90 plus and then come below 90 plus. But then basis the 12th number circular, they have to be called an NPA. And when they are called as NPA, then to remain out of PCA, you need to make provision of that. So that has been the issue. But let me assure you, the team has actually, in fact, the team had several sittings separately, because obviously this is a figure which worries us also, to decide what is the future going to be. And the team has taken robust targets, which was not the case maybe immediately after the COVID. They were slightly after the second wave. That was not the case. But then now the team has taken robust targets. Things have opened up. They are telling that the industry will see a 8 to 10 to 12% kind of growth. And obviously the prices have gone up. Therefore, altogether will benefit entities like us, which are fully focused on this. But I think disbursement will definitely go up. Our biggest challenge would be to first bring down that 148 crores, which additionally went into the NPA bracket because of the 12th number circular, and separately simultaneously bring down the other accounts which are in NPA to below to the zero bucket, and then grow. The team is confident that they will bring down the NPA to a considerable level, to such an extent that we'll end up reporting a decent or I would say attractive number for the current FY23 financial year.
Okay. But just to take some more clarification, how much could be recovered from the amount which has been written off, and by when that would be happened? Not an exact timeline or exact amount, but a ballpark kind of figure?
See, we have written off in the I will just clarify. This provision which I am talking about is not written off. It is the written off amount is about 18.7 crores only. Okay. Out of the total loan loss provision, everything else is merely provision. We are saying that no, we are just making a provision. The write-off is of 18.7 crores only. And out of that write-off, normally over a 1 to 2 year period, we get back about 20%, 25%. But this is only provision.
Yeah, regarding provision only, how much could be recovered from that 148 you are mentioning, and by when it could happen?
Let me give you a different way to. Let us look at it differently. All these accounts, this entire 148 crore book, these are the set of guys who are paying on a month-on-month basis, but then sometime after 12th of November, they have sometime gone into a 90 plus and then come back below 90 plus. Now, RBI regulations says that unless the fellow comes back to zero, you cannot take him as a standard account. So, they are paying on a month-on-month basis. Nobody is defaulting because these are those accounts which are less than 90, and that means they are paying. In fact, if you look at the website where we have put up the presentation and you look specifically at the NPA movement, you will realize that the amount which is collected against the NPA accounts in the current quarter is about 8.36 crores, which is from about 59,000 customers. So, sorry, I'll just a minute. The total amount collected is 36 crores from about 59,000 customers in the current quarter. So obviously these are the guys who are paying. So maybe they will, even if they continue to be NPA, these accounts, they will continue to be paying and maybe complete their payments maybe within 2-3 months after the tenure gets over.
Okay, got that. So it means that the provisioning will be recoverable in next 5 to 8 months. We could expect that.
Yeah, the intention is that these are the low-hanging fruits, because this fellow is a regular payer. the teams have been actually mobilized to attend to each one of them, saying that no, you currently pay the 3 months dues immediately, so that this account goes out of NPA. Because and we have given immediate targets to the team, saying that no, these many accounts should come down every month out of the 148 crores. So, and intention, and now the second ask is to ensure that there is lot of control in the 0 to 60 kind of buckets, so that the guys don't actually go into 60 to 90 or beyond 90. So then he has to pay 3 installments, it becomes difficult for him to pay. And we understand people are coming out of COVID, and 2 circulars which actually are for the customer to pay is definitely a tough call for him.
So finally, could we presume that the worst is over by FY22, and from FY23 we could only see better and better things ahead? Could we?
That's an assurance you should take from us, that FY23 will be far significantly better than what FY22 or 21 or 20 or even 20 was. Okay. That's an assurance which we would want to give.
Okay, thank you. That's all from my side. Thank you very much.
Thank you. Our next question is from the line of Vidhi Shah from Antique Stock Broking. Please go ahead.
Yeah, thank you. So firstly, just one, and we have been seeing slippages around 60 crores every quarter. So do we expect this number to come down going ahead? That will be the first question.
Yeah, which is where we are interested. When I was replying to Vinay, I think I was saying the same thing, that we would want to, and we are having 2 sets of teams. One is specifically to handle the accounts which is the 148 crores, which went to NPA and then came down below that, and still in the 0 to or 1 to 90 space. That is one set of team which will be following. The second team is mandated to separately follow up on the accounts which are in 0, 1, 2, 3 and not yet gone to 90 plus, and their job is to ensure that it doesn't go to 90 plus ever, to try and block them at 60. And that is one task to them. And the third set of teams is there to subsequently handle the NPA accounts. So, and the team has taken up this task to ensure that they have a robust collection process, significantly better than what it was ever in the organization history, and try and collect the amounts as much as possible. So while 67 crores was actually added in the last quarter, 67.9 crores, and only 23 crores out of that moved out, we will ensure that the additions in the subsequent quarters are significantly lower. So this we actually accepting that this 12th November circular has to be fully adhered to without waiting for the relaxation period. It is better that we ensure that nobody goes to 90 plus agents.
So should I take it that from Q1 itself, like from the next quarter onwards itself, the slippages will be significantly lower compared to these past few quarters?
Yeah, it will be significantly lower. In fact, the team's budget that we have taken is also indicating the same, and the regular meetings that the team has with their superiors, the team has with the Chief Operating Officer, and the team as with the director is all indicating towards that, and all have taken it as a challenge. Because obviously 1 year or 2 years of 2 bad years is definitely not something which we would want to show to the outside world.
Okay.
Giri, let me kind of get into this. So if we look at the performance of as on March, and let's divide this problem into 2 pieces. One, is the softer buckets, how they are going to perform, and one, the NPAs, how we are going to roll it back to zero so that, we can have the reversal of the provisioning. Bucket X performance was about 97%, which was highest, over the last almost 1.5 years. Okay, 97% means only 3% slippage from the zero bucket or X bucket, which generally in the industry is 93 to 94%. So we have kind of improved on that. So of course, the kind of cash flow improvement in cash flow for the customer would have happened, and that's why we are getting the payment on time. Bucket 1 and 2 also performed the best over the last many months. Bucket 3, that is 60-90, because of which we have taken additional provisioning, which Vinod mentioned. The performance was 90%, which means that out of 100 rupees principal outstanding, 90% of the cases we were able to get at least one installment, and that did not flow into 90 plus. The issue is that in this 90%, if we bring it back to zero, then we need not provide it, in our books. So 90% performance in that bucket has to be pushed back to bucket 2, that is, 3160. So what we are seeing is across buckets, we are getting the cash flow of customer has improved and our performance itself has improved. So this is a stage where we can say that we'll be able to seal the slippages from all the buckets. I mean, it's very important because 60 plus is where we want to bring down our portfolio. So from all buckets, we see that the performance has improved and the roll forwards has been in control. And once we continue this, I think, we'll see significant improvement and reduction in the NPA.
Okay. And sir, just data keeping question. What will be the coverage on stage 1 assets and stage 2 assets?
1 second, ma'am. On stage 1, stage 2, on a total outstanding of 1,425 crores, the provision that we have taken is about 30.36 crores. So coverage is about 2%.
No, I want it separately. Like for stage 1 separate and stage 2 separate.
Can we, you have it ready with us, should we share? Can I make a note of it and mail it to you separately, ma'am?
No problem, sir. And lastly, sir, do you have any disbursement target for FY23?
The team has taken a target of about 2,250 crores, and we are currently working on that, saying that no, we need to do. But our only, we will monitor it on a daily basis, and our request is you at all the quarterly meetings to ensure that you raise this question with us, so that that is also effective.
Okay, got it. No problem. Thank you. That's it from my side.
Thank you. Before we take our next question, we'd like to remind participants to ask a question. You may enter star and 1. Our next question is from the line of Akhil from Robo Capital. Please go ahead.
Hello, good afternoon. Am I audible?
Yeah, yes, Akhil, you are.
Yes. Hi. Just regarding the last question that was asked, since you mentioned the target of 2,300, I just want to know, so going in FY23, what would be the ticket size and the number of loans that you will be doing? Would it be around 76,000 only and let's say approximate 2 lakh loans?
Just a second.
Vinod, can I reply?
Yeah, you reply 2,73,000 is the figure.
Sorry, I didn't get that.
2,73,000 loans is what we are talking about. This year we did 1,45,000. We are saying it will be close to double.
So close to 2,73,000.
2,73,000 is the figure. So you can say about 2.75 lakhs. You can put it.
Okay. And the ticket size would be around?
Roughly 76,000.
Oh, 76,000 only. Okay, fine. And so regarding the provisions, so since it'll take time for you to, reduce the provisions going ahead, I just want to know what would be the credit cost for FY23? It will be much higher, right?
The credit cost should be much lower in the sense the focus will be first on this 148 crores which are low-hanging fruits, which should definitely ensure that the credit costs keep coming down on a month-on-month basis. On a full year basis, we would want to target about 2.5%.
2.5%.
Yeah, because we believe that the bad times are over. Collections have improved. It is only improving. In fact, the slide that we have put up, it shows actually that between quarter to quarter, the numbers are gone. It's going up on a quarter to quarter, not sufficient to pick me out of the CPA in the current year. But definitely numbers are improving on a quarter to quarter basis, and it will only improve as we go forward.
Okay, fine. Great. Those are my questions. Thank you.
Thank you.
Thanks.
Our next question is from the line of Sarvanan Balakrishnan, an individual investor. Please go ahead.
Yeah, thanks for connecting. So my first question is on the current borrowing mix. Like how is the current liability mix looking like as of today?
Sarvanan, give me a second. I'll just show you. Currently, the overall borrowing cost is at about 8.82%, versus about 9.52% last year. So obviously, in the current year, the cost has come down significantly. In fact, I made a mention about it in my opening remarks, saying that a lot has to do with the credibility that the group has, and definitely, in spite of our lackluster performance, we have been able to bring down the cost, which is definitely we feel it's a big credit for the company and the group per se. Regarding the kind of loans that we have, see, roughly 68% of our loans our borrowings are in the form of bank loans. Roughly about 2% in the form of subordinated debt, 4% in the form of public deposit. NCD as of 31st March was about 17%, and others are about 1%. The NCDs are being paid up. In fact, we have taken about 275 crores last year, or the year before last. About 125 crores was paid up by 31st of March, and has been paid yesterday and today. So let's say, NCD will also come down. So our total majority of the 17%, let me correct, 17% is from PTC and DA, and NCD is 9%. So that NCD will come down. We plan to do a lot of PTC and DA transactions, which will take it back to the 25-30% kind of level. So that would be the broad mix in the current financial year.
So, is it something like which we will have it consistent in the coming years as well, from a liability mix strategy standpoint?
It would be, but when we will keep looking for methods of borrowing. In fact, there are two other things that we also would do, or we are speaking to various people about it, various banks about it. One would be co-lending, sourcing for somebody else. So obviously, some portion of it remains on our books, some portion remains on the books of or a larger portion remains on the book of the bank. So that would be, while it is not exactly a borrowing, it's a sort of we taking money from somebody and sourcing and handing it over back to him. So I would call it as a hybrid variety of TTC. So that should be there. And maybe we look at bonds and things like that, which would also be there in the, you'll see some of it in the first or definitely in the second quarter.
Correct. So with interest rates going up, what's the conscious direction that we are again taking? So now I remember in last year, so we had discussed about auto being recovering, right? But it seems like now with rates going up and like slowdown in auto, like will we see like further impact in terms of from a disbursement and growth standpoint, primarily from a vehicle loan standpoint?
Sorry, I didn't get the last sentence. What did you say? Particularly from
the last question was on the vehicle loan part. Like, so I remember like 1 year back, like we anticipated like, the auto loans would sort of again recover, right? So auto sector getting recovering and so disbursement and good opportunities coming there. But with interest rates going up, like the cost of capital also goes up, right? So which has a significant impact on the vehicle loans as well.
I fully subscribe to your point that the interest rates will go up, and definitely that will have an impact on the cost of funds. From a 8.8%, which is the purely interest cost. In fact, I have budgeted much higher figure for the next financial year. This is the interest rate going up, and definitely this is the kind of P&L that I'll put up before the lenders. So obviously that's the point which is taken. And but when the interest rates are going up, we being a part of a larger group, we are confident that lenders will take cognizance of the fact that it's a one-off, and they will give us the benefit of that as far as the performance goes. And definitely because of the comfort that they have with the group, we will not be hit as hard, number one. Number two, obviously, when the interest rate goes up because of factors other than my own performance, my cost will also go up. And when my cost goes up, we can cater to the segment where possibly raising my cost, my rate IRR on the yield from them may not be that much of the difficulty. So we are fairly confident that cost will go up definitely, but then we are confident that my yields would go up, which would compensate for any increase in cost. Maybe there would be a timing lag, which would be taken care of.
Got it. And in terms of geographical presence, like how is this looking now? Is it like South being 50-60% and like the other segments remaining 40%, is it? Or like will this number significantly distribute across multiple zones?
Currently, South is at about 66% and the rest of India is about 34%. We are looking at growing North, East and West significantly. But then I would say that Delhi South could possibly go down to 60-63%, where it had gone to 2-3 years back. And that then we had pushed aggressively North, East and East. So, and North and East and other things, they will possibly go, or put together will possibly go to 35-38%.
Got it. So what I have noticed historically in all the like microfinance businesses that like usually the NPAs are higher in the north and west zones. Right? Is there any particular like reason like why the NPA is higher in these two zones? And do we have any threshold percentage that will again disperse to each district within each zones? Like any controls on that side?
Madhu, you would want to take this question?
Yeah, sure. So North and West, because the market is like that, in the sense that it's a very competitive market and it's a voluminous market as well. And for larger markets, these kinds of issues are there. But key is how we manage our portfolio, and that is where, and I have mentioned that many times during such calls, that we have our way of assessing at dealer level, at location level, each and every market where we are performing, and is there anything wrong in terms of collections, and we try to adjust or pull out of those locations or dealer and continue with profitable dealers. This was COVID was it impacted across. I mean, it was not that certain pin code or certain city or certain town was impacted. It was across everywhere. So it would not be right to pinpoint certain things, but our own risk management system tells us that okay, these are the areas where we should focus and not focus. So within those areas, north or west or east or anywhere in the country, if If our risk metrics say that do the business, we'll continue doing there, and wherever we see any kind of issues, we'll curtail our disbursement. It can be through reduction of the funding quantum or reduction of volume or exiting that dealer. These are the things that corrective steps happen. So while the market, any market can be a problem, okay, the risk management matrix has to be strong, and that is what we try to do when we grow our business.
Got it. So are we looking for any capital raise in the near term?
I think in the current year we would, after the first or second quarter, we'll definitely look at that, because for growth we believe that capital is needed, because we are looking at good growth or massive growth, and for that, in the past we have always been doing securitization and direct assignment to ensure that we don't need to go and ask for more capital from the equity investors. But then I would distantly, my feeling is that there needs to be a fine balance between the two. So I believe that basis the promoter director's concurrence, we will definitely want to look at some bit of equity risk.
Got it. Makes sense. And that's it for me. All of it.
Okay. Thank you.
A reminder to our participants, if you wish to ask a question, you may enter star and 1. Anyone who has a question may enter star and 1. We have the next question from the line of Vidhi Shah from Antique Stock Broking. Please go ahead.
Yeah. Sir, just one last question from my side. So basically, I understand that because of COVID, somewhere our GNPA levels have shot up pretty high. But if you can just ensure that, or you can just give some understanding that going ahead, what risk management practices or corrective actions you have taken, so that just in case even if any event happens, there is no more of spike in asset quality, whatever growth that comes.
Madhu, you'll take it.
Yeah. So Vidhi, I mentioned just before this that we will continue our risk management metrics, nevertheless with a bit more oversight into the ground. We have enough information what is happening at the local level, which has impacted due to COVID and not because of COVID. So both things we are, earlier we used to have a natural market where we have to only just decide basis of figures. Now we have something which has impacted by a COVID across. Okay, so there are two factors that we bring into play. But I believe that whatever impact of COVID was to happen has happened, and it is over by Q. Okay, so whatever impact of cash flow that customer would have had, and they would have bounced back. Some of them bounced back, some of them did not bounce back, some of them are taking more time to, and that's what we are hoping that, while customer is in an NPA, he's paying one installment, two installment, but still he's an NPA. He's an active customer. Okay, so we recover money from them and bring them back to zero bucket and come out of NPA. So these are the things that would happen. But the cash flow impact, we believe whatever has to come in front of us has come, and from here it improves. So we'll come back to our normal risk management metrics. Of course, we have tightened our credit in terms of specific locations where we feel that besides COVID, these markets are not functioning well because of various reasons. So that would continue. And we believe that maybe next 6 to 9 months will come as a business as usual risk management metrics. So whatever we had tightened when the COVID started, and so we were talking about top line as well. In FY21, hardly we had 6 months to function. We did about 1 lakh unit. and in FY22, till let's say July, it was like, impact of second lockdown, and July, August was also impacted. So we had close to 6 or 7 months. We did about 142,000 unit. Okay, and we believe this full year would be something where we can see what we had done in 1920. So we are benchmarking ourselves to 1920. So when we are benchmarking to our numbers to a normal year, risk management metrics would be akin to that. But we have a lot of new learnings. Okay, so those learnings would become part of risk management metrics. Very importantly, we use a proprietary scorecard. It is getting recalibrated with the events that have happened past 2 couple of years or 3 years. That would get recalibrated, and so we'll have a set of metrics which would be relevant for as we go forward. So we can give you more inputs if we can get into a separate call where risk management team can be there and they can explain what exactly they have done, because these are all data driven, analytics driven. It needs more discussion and insight.
Okay, got it. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference back to the management for closing comments. Over to you, sir.
Dear friends, it was nice of all of you to be on the call and hear us out and also raise queries that you had. We all agree that last year was a very turbulent year for us, as maybe even worse than the FY21. But we are confident that no, it was a bad dream which has ended, and therefore we are back on our toes. We and the team has taken specific targets for themselves. They have taken aggressive targets for themselves, saying that they will achieve whatever needs to be achieved to ensure that we are out of this and we start becoming a profitable entity once again. FY23 will be the turnaround year. We are very confident about that. We would want to, we have put up our presentation on the website. We can share any more information that each one of you want. If you feel that there is something that we are doing wrong, we are going wrong somewhere, my request is please call us up separately and inform us. Intention is we want to ensure that we come back to you quarter after quarter, showing better and better performance as we go along. Thanks once again. We are all hopeful that things will improve and improve for good. And we need support from all of you in this at this hour. Thank you.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.